I think there's a high risk that we could see this, result in a protracted bear market. There's two things to take note here. One, once more, that if you look at what the Trump administration and the Israelis are actually doing, rather than just saying, there is a build-up of, again, a military presence in the Middle East that suggests that this could escalate further. And then even under the best set of circumstances where this ends practically tomorrow, because of the damage of key infrastructure and other disruptions, the energy complex or energy prices are going to fall much slower than which they rose.
Now, Iran has rejected a US proposal to end the war with a 15-point plan and published 5 conditions Tehran is seeking. Now, what do you think the markets do with that information?
Well, at the moment, what they are doing is trading on the headlines and trying to decipher what it means. It's a bit of a game of he said, she said. So really, the last 24 hours of trade has been reacting to, obviously, the constructive language ostensibly coming out of the White House, and then the denials coming from the Iranians. And of course, that's impacting the energy complex in particular. And everything at the moment is pretty much trading as a derivative of the energy complex. So really, we're moving from headline to headline here.
Do you accept everything that you're seeing and reading?
Well, not necessarily. I mean, there's effectively what the United States is saying and what it could potentially be doing. And what it is doing is building military personnel as well as resources in the Middle East. And it's looking potentially like it's trying to set the groundwork for a ground invasion that may involve opening up the Strait of Hormuz, because of course that's the critical choke point here, both for the war as well as the global economy. So that's what we're really waiting for now, as to whether there is that escalation because negotiations don't go through, and that could be a significant volatility event if that does happen to occur.
Now, it seems like markets are favouring positive headlines about the war rather than negative ones. Is that true? And if so, why?
I think markets are looking for any signal of escalation, and there is certainly the case that going into the start of this week that markets were looking at a very severe escalation. Of course, we had those threats by US President Trump to start targeting power plants and other energy infrastructure, and a potentially catastrophic set of circumstances if that were to occur. So there is an element there of the markets now pricing out that kind of bad news. But again, that could turn very, very quickly, and very, very quickly we could see markets much more focused on the negative headlines of another risk of escalation.
Well, I mean, are the markets still holding on to the idea that Donald Trump will find a so-called off-ramp? Is that still making its ways around market circles?
I think so. I think there's still a degree of complacency, like there has been since the start of this war and throughout it, that there will be a suitable off-ramp found and that both sides can de-escalate. My fear is that, again, because of the build-up that we're seeing in personnel and resources in the Middle East, that this could be a little bit similar to the last week of February, where markets were highly complacent, rather calm, looking through this risk, only to be caught off guard. So it's a very, very open question as to what happens next, but I certainly think that there is the prospect there of another nasty surprise.
The volatility, though, is that creating opportunities for stockbroking firms and for fund managers and hedge funds, or is it creating a massive headache for people?
I think on balance it's creating mostly a headache, because the kind of shock that we're looking at here is a stagflationary one, which means both weaker growth and higher prices, and that's basically kryptonite to all asset prices. Really, the only beneficiaries so far that we've seen consistently, and this was fleshed out in the market today, was that defence stocks rise on this, energy stocks rise on this. If you have exposure to the US dollar, that is also something that investors or traders benefit from there too. But on balance, this is a weight across asset prices, and again, it just comes down to the nature of this shock.
Just briefly, all eyes are on the Strait of Hormuz, the free passage of ships, and this war coming to an end. Are you hopeful of a near-term resolution, or have we already passed the point where we can see clear air? And given that, is it possible that it really only is going to be, we're in the middle of a correction, for example? Is that really the reality we're facing?
I think there's a high risk that we could see this, result in a protracted bear market. There's two things to take note here. One, once more, that if you look at what the Trump administration and the Israelis are actually doing, rather than just saying, there is a build-up of, again, a military presence in the Middle East that suggests that this could escalate further. And then even under the best set of circumstances where this ends practically tomorrow, because of the damage of key infrastructure and other disruptions, the energy complex or energy prices are going to fall much slower than which they rose. That means that there is still going to be growth and inflationary impacts. There's going to be interest rates higher than they would otherwise be, profits than they would otherwise, lower than they would otherwise be. That's going to have a really long tail. So I'm filled with a degree of pessimism that there's still a lot of bad news still to come because of this crisis, whether it ends tomorrow or not, for example.
Okay. Kyle Rodda, terrific to have you on the program. Thanks for your time.
Thank you.